Okay, we are here with the one and only Dave Butler, the gentleman that when I needed a mortgage and I couldn't get a mortgage, and Nick said, I may have a guy. I'll never forget. I'm Tom. I may have a guy. And your work ethic, dude, when we first crossed paths, I feel like you worked 25 out of the 24 hours a day. And I remember speaking to you, and I'll just never forget. I was leaving my software sales job. You called me on my cell phone. In about 30 seconds, you asked me 85 questions. I answered all the questions. And like the next day, you managed to get an approval. I think it was like a student rental. I was refinance. I don't even know, but I know it was like complicated.
Is it weird that I remember the property 20 something years ago?
Yeah. Do you remember? Come into the mic. Come into the mic.
Am I in?
Yeah.
All right, good.
You can remember it. That was my first crossing paths with Dave Butler. And then you're like a tornado force of energy. So since then, it's just been like Dave is the mortgage guy. So now I just want to get a quick update. What are you currently? So yeah, what's going on? You're currently. What is the mortgage business now that you're operating?
Okay, so Dave Butler is no longer part of Butler Mortgage. It was time to get a new brand set up. I think for those that know of maybe Butler Mortgage, it's appearing now to have a bit of a TikTok presence or something like that. So, it's in listen, ultimately Butler Mortgage, was a company that I formed about 10, 12 years ago. Prior to that, I was with Mortgage Intelligence, if you remember. That's
oh my God, I forgot. I totally forgot.
I was a mortgage agent at Mortgage Intelligence. And then, I have other family members that are in the mortgage business. So we had decided at the time to kind of form Butler Mortgage. And, over that time, the brand, because we all work together as investors. And then Butler Mortgage, the other side, my other family members were kind of turning it into more of like a rate discount site, on mortgages. And it just the two brands didn't necessarily mesh, you know what I mean? And nothing bad. It was just more of a situation of like, we would get calls from our investor clients being like, hey, we saw your interest rate on the Butler Mortgage website. And, and taking 15 to 20 minutes of your day to explain to your client that
why you can't get that rate.
Yeah. Like these rates are different. And you end up, so ultimately, and it was even just for our staff as well. It is very difficult to, have these talks. I mean, because if you add them, I'm a numbers guy, I'm a data guy. So you start looking and going, okay, well, if we explain that to 100 people this month, that's X amount of hours we've now spent, times that by 12, you extrapolate the data and you're like, hey, we're spending X amount of time every year.
So it was like there was two divisions and they weren't synced up and it was causing extra effort.
Yeah. And it was just time to, I don't know, every 10, 12 years, I like to, just switch it up a bit. So yeah, I went from Mortgage Intelligence to Butler, creating Butler Mortgage. And then now, I've sold off my shares in Butler, and myself, Daniel Patton, which everyone will know. He's not everyone, but he's my my lifelong business partner. We were buddies when we were teenagers, and 30 something years later, we still run companies together. And so we decided to open our own brokerage called Better Mortgages. And of course it kind of ties in well because we have our real true love is our company called Better Mortgage Select, BM Select. That is our company that is dedicated to working with real estate investors. The staff that we even hire is got to know how to do real estate investor mortgages. There is a prerequisite in our company. You have to, when we hire underwriters, you got to have an X amount of years of experience, or else we just know you won't be able to necessarily handle what comes about when we're working with a client that has 12, 13, 14 properties. These are not easy files to work on from a mortgage standpoint. We love work.
And there's still investors out there. Are there? Yeah, there are. Okay. You can confirm. You can
they're
confirm
out there.
this?
I don't know if they're doing anything right now. But so I mean, Better Mortgage is the new brokerage. I'm really excited about it. Better Mortgage Select is obviously, nothing's changed. Our BM Select company is still there. And to be fair, I'm really excited I like growing things, man. So, it's, this will be a new chapter.
Yeah.
And, just ultimately looking forward to running it. We've got a really good, Lorenzo, Michael, we've got a really, really solid group. And, I really appreciate working with a younger group of people too, because they give you a different different color, different insight, different things. And it's actually like, I know Dan and I learn a lot from this younger generation. You know, like Lorenzo's 25 years old, been working with us since he was 17, and he brings a whole different perspective and insight into, you know, the newer age. Like, look, like, you know, I always think about it like this, like you and I, when we were buying in these properties, I mean, this was also 2 decades ago, and you know, how much life changes in 20 years. And now, you know, I rely on a lot of these people in the younger generation, and much so, I'm sure, like you with Aiden, like with your son, he's so in tune with his generation and what's going on that I know for a fact he must be able to provide you with such valuable information that helps you and Nick kind of move forward within your business, within different segments of your clientele, right? So
yeah, just some of the conversations that generation is having, like finishing school, looking around and going, some of the conversations I don't even like to hear that they're having. They're looking around going, where can I afford to live? Yeah. Do I stay in the Greater Toronto, Ontario area? Do I move to Calgary? Do I move to Florida? You know, not knowing how they would legally get there to work, but do I just like, is it worth building my network and roots here? And you can't help but think they might be right to leave. You know, why would you want to build your roots? Sorry, I don't know if we're intending to go down there, but it does give you insight in having the conversations, because that, for my generation, wasn't the conversation. The conversation was, hey, you're going to get quote unquote good job, work a little bit, save up a little bit. Do you know a bank guy? Can I get a mortgage? Okay, what do I qualify for? They're not even entertaining those kinds of lines of thinking in this area. So it's just wild to see how far a country can change so quickly.
Well, yeah, look back. Well, like I'm a data nerd. So it's like, I still remember the exact price I paid when I bought the first house I ever bought.
Mississauga?
Yeah, little in Meadowvale area, single car, attached garage, right? $281,000 in 2006. And I remember that being like, wow, like, you know,
you got ripped off.
It got ripped off. And actually, what was funny about this story is I remember calling my dad to tell him that I bought a house for $281,000. My dad's such a real estate bear. He says, well, I hope you're prepared for that house to be worth less in a year. And I was just like, man, I don't know.
Wish you bought the street.
Like, I don't know if you understand how this market works, but anyways, that's a whole other story. But no, I think, look, you make a good point. You know, talking to some of these younger people coming out of school, you know, the dream seems like a very far, like, fetched reality. Like, it's like, it can't be there. Like, you know, imagine you're coming out of school, you and I, and we're like, okay, great. I've got my job. Now what's my next thing? Okay, great. I should look at buying a home or something. Oh, no, $800,000 for, you know, a house that, you know, I couldn't even really necessarily.
So Aiden wanted me to ask you this question. So they must be having, him and his friends, can a young person today qualify for a house, in your opinion, without their parents' help? Do you see that happening? Or what percentage of young people qualify that under 30, maybe, whatever you want to say it?
So it's really rare for anyone under 30 contacting us, where it's just, you know, one client, or maybe like one client with their partner at the time. Again, if you're under 30, it's really hard to call. You really have to have a large income. Now, again, if you're someone sitting here, you're like, I'm 26 and I'm making 130 and my girlfriend's making 80. Yeah, you're in the game, man. You're in the game. But I mean, that is not necessarily a super realistic. It happens, but you know, it's we don't see it a lot. Yeah, no, Bank of Mom and Dad is a real thing now, and it's not just Bank of Mom and Dad where they're coming in and helping with down payment and whatnot. It's Bank of Mom and Dad coming on the application because we need their income to help qualify. I have never in my life had more mortgage applications with more than 2 people on them than in the last 2 years. It used to be like banks didn't even like applications where there was more than 2. Now,
shit, I never thought of that. So you're seeing it all the time. Because I remember working with you at one point, and you were like, a mortgage over. I remember asking you at some point, like, Dave, like, do you see mortgages over 500,000 or 600,000? And I think you used the words, and maybe I don't remember it right. I think you said, oh, those are like considered jumbo mortgages and need a second level of approval at the bank.
Yeah,
you know, like 600,000. And now I feel like a 600,000. Well, you'll know better than me.
It's average.
Yeah.
It's average. Yeah. I think our average.
Was that right? Did I remember that as a jumbo mortgage
at one point? Anything over, like when I first started in the business in the early 2000s, anything over a $500,000 mortgage, you were like, well, that's a big mortgage. Like that's a jumbo. Like that's, and it did. It a lot of times need an extra level of clearance at the bank for approval. But a $500,000 mortgage is now the average. I think last year our average mortgage was $476,000. So it's yeah, it's
So now the average is higher, and there's not just one person on it. And then what people are buying is less. I'm only chuckling because it's ridiculous. Are buying less and less space.
Yeah.
So you project this out further. We're not building single family homes. I want to ask you about some condo data that you just shared. But like in the next 5 years, I don't even know how to anymore extrapolate out the data to understand where we're headed.
Yeah, well, actually, I can even get to that. But actually, I want to go back to Aiden's question. I have a very interesting situation that I think it would be cool for the general public to understand. And that is that I had someone about Aiden's age. And he had just got his job at Ernst & Young. Maybe if he hears this, he'll know I'm talking about it. Pretty good income, like, 80, 85. So, and he had, he's out of school. He's been working for a couple of years. Now he got like this is his job. He's in his mid 20s, definitely, probably 26, 27. I know he's a little older than Aiden, but he had managed to save up. Like he has actually he saved up quite a bit in the sense, when I say quite a bit, he had about 60, 70,000 bucks.
Awesome.
Which
hard to save that.
Very hard to save. I mean, he was living at home. He was saving every dollar he could. He was living extremely frugal. And we were talking, and it turns out, I said to him, you can't buy a home for yourself. Like you won't be able to buy a home for yourself. I'd have to bring on mom and dad, And he did not want to do that. He's you could tell he's very independent. Excuse me. So in the end, what we ended up talking to him, I said, look, this is going to sound really crazy, but if you can find a rental property for about 300 to 350 so that your down payment that you have saved up equates to up to 20%. This is going to sound crazy, but I can actually get you an approval if you're buying a rental, because he was living at home, right? So the idea was, if he goes and he's going to move into that house, excuse me, he has to qualify for that mortgage completely on his own. And that was the problem. He's got 70,000 down payment. He wants to buy a place for like 600. You do the math, it just doesn't work. But if he finds a place for 300 to 350 and his 70,000 represents roughly 20%, then I can now go to the bank and say, look, he's buying this as a rental. I now get to use the rental income because he's living at home. He doesn't have the biggest payment that all applicants have going against them when they're buying rental properties, and that is an owner-occupied home. That is your home. If you're paying $1,900 in rent and you want to go buy a rental property, the bank's going to count that $1,900 in rent against you, and that's not going to be favorable. But he lived at home. And so the banks use a very small amount of what they call a living expense for when you don't have a rent payment, you don't have a mortgage payment. And by doing all that, we were able to get him approved to buy a rental. Now, he had to switch his whole gear, and he eventually, after a couple months, he came back and brought a property, $339,000. He closed. He's now a homeowner. But to your point, like, what is a valuable option now? What is the dream now for someone that's in their mid-20s? Look, that might be it, in that you are instead save up enough that you normally would use for a down payment on a home that back in the day would work, and instead now use it to buy rental. And now people will say, well, that doesn't solve my problem. I want to move out. I totally understand that part, but it gets you in the game, and it gets you earning equity, and it gets someone paying your mortgage down. And the ultimate goal, and what I sold him on was, look, I can't change where the market is today, but I can put you in a place where, as things go, you can take the benefits of being a homeowner and building that equity. And then down the road, let's picture a bit more long-term, 5 years, 7 years down the road, you're in your early 30s now. Maybe we get that 70,000 you put in that property, you sell it or maybe refinance it. And now we're pulling out 150, 200,000. And now maybe you've got a girlfriend or a wife at the time. And now we can actually get you to qualify on these crazy prices and everything else, because you'll have this big 20% down payment, $200,000 hopefully. And that was the plan we had to set out. But this is very different than 2002, where you sit down with someone who wants to buy a home and it's very simple. Do you qualify? Not da da da. It's ABC.
And now you have to get creative.
All the way to
you still feel fairly, I know you don't have the crystal ball, but you still feel like, real estate's something you should own then.
I don't know what else too. In the sense of, obviously I'm a mortgage guy. I know everyone else, all the investor, you should own this. I just think there's a benefit of obviously having an asset that acts multifaceted, meaning you get to sleep there. If it's in the case of your owner occupied home, you get to raise your family there. And obviously in Canada, it has proved to be a very valuable asset class. And not just Canada, but obviously a lot of the G7 countries. It's a very valuable asset class. It is now something you would put on the same, when you're talking about having an investment portfolio, you talk about, having your RSPs, maybe your TFSA, some stocks, other things. But if you don't have housing in there, I don't necessarily know if that's a complete investment portfolio these days. Now, you go back to maybe 1940, 1950, and you might say, well, yeah, a $40,000 house, that's tough to group into asset class based, person's making 80 grand and their house is 40 grand. Well, but the reality is now that's not the case. You make 80 grand, the houses are worth 800 grand. If you can own it, you should probably own it, and again, I like the multifaceted thing. And I also I'm weird, and this. I mean, I always looked at housing a little differently, in the sense of, as being in the mortgage business, I was very privy to learning about private mortgages when I was really young. I learned about private mortgages when I was 19 years old, and investing. And I actually met, believe it or not, these, we still talk about him today. We call him the Megalodon. His name's Terry Wallman. And Terry Wallman is, if you ever look him up, Walman. He's amazing. He's the power of sale lawyer in Toronto. If you are a private lender and your borrower is not paying you, and you need to get that home in a power of sale so you can get your money out and become whole again, he's the shark. He's the one. He is, and it's all legal. He will get it done. He's a power sale. His specialty is power sales. But what Terry is not just a power sale lawyer. He is one of the largest private mortgage lenders in Canada. And I learned a lot of even the rules that I use on how I will lend privately are all built from Terry teaching me these things. And, what I would say is that I looked at, owning real estate eventually. Let's say I have a bunch of properties and they're paid off now. And I know that's a dream for people, but I mean, at the end of the day, as an investor, if I have a bunch of properties paid off, let's even say rental properties. Okay, I got it paid off. So that means the rent that's coming in I'm doing very well, right? I got no mortgage. I'm paying my property tax, my home insurance, and the rest, after I pay that, the rest of the rent is mine. Awesome. Well, I always looked at it, and Terry had taught me that, why not take that investment property now, get access to some funds in it. And this is different. This is when line of credit rates were 3-4%. And now use that equity in that home to now become a private lender. So you now actually turn this property into what we would call the triple threat, right? You got the appreciation of the property. You got the surplus that you're making off the rents minus the payments. But then now you've turned it into this on steroids investment, because now you're taking equity from that home, lending it out at 12% and paying 3% on it. So it just becomes its own investment vehicle. And I got really, really pumped about that when I was really in my early years. And yeah, I did everything I could to, I spent my 20s basically, as you said, working, but more or less because I had a goal. The goal was get my stuff paid off, get in this position. And then once you are in this position where you're taking investment properties and actually doing something that other people aren't doing, that's a whole other thing. So for those that have, properties that have a lot of equity in them, and I only like, and to be fair, this particular private mortgage thing, I really do think it's something that you only do when you got it paid off. And I know people would be like, well, that's stupid, Dave. If it's half paid off, I should use that equity. And I just think
it's too much leverage.
It's just, yeah, you gotta, investing's a really weird game, right? You gotta be really careful.
To survive.
Yeah. And look, what we're going through in the last 2 years should show any investor that you really do need to look at where you are in the leverage game. And, I thought that was more or less it kept the goal alive, I guess what I mean. It's when I got to zero, I knew I could lend out privately on that thing. And I had set that. It was a mental thing that I had just said. Say, when the mortgage is paid off, now I will lend privately on that. But until then, I keep focused on that goal, get it paid off. Whatever money I was making from my companies, whatever surplus I was getting from any of my rental properties, any money that I was lending out privately of my own funds, all that money was going into paying down the mortgages. And again, some people will say, I was stupid. You were paying off mortgages at when they were 3-4%. But sometimes it's not just about the numbers. It's about your life and your comfortability and just sleeping at night. That's
what we learned from the 1990s when our father went through that. Everyone was like, why aren't you and Nick Mack? I don't understand, guys. Why are you not building subdivisions? Why are you not layering on more properties? And we're like, I don't know if it's always going to be like this. We just want to have a debt to equity ratio in our lives. For our business and our lives, we need operating capital for a business. There's payroll to meet. We just are we slant more conservative because we don't know what's coming. And that just for me was the 90s when I just saw people. And I feel like we just lived that again. Like all the 2010s was everyone leveraging up. Real estate, you could do no wrong. Now things have been a couple years of change and you're seeing some shit hit the fan. And it's like, leverage always isn't the greatest thing. But you're looked upon as stupid by a lot of people. Like they literally look at you as if you're stupid.
Yeah, if you go on Twitter and tell someone on Twitter what I just told you, they say, well, that's dumb because they could have made X, Y, Z on this return and done this and done that.
Survival is more important. Staying in the game is more important than just getting kicked out. Like it's like a margin call on a stock portfolio. Like, you never want to get that call. And that's kind of what can happen on the real estate world. Why do you, so then I'm curious, we talked about this a little bit before we started recording, but I want to get your thoughts. Why, rates have been relatively high for some time. How have Canadians been hanging on? All the Globe and Mail, Financial Post, whatever article you read, it's like, holy crap, the Canadian consumer is pretty resilient. Like that's the word. Like, oh my gosh, they're very resilient. So like, what's going on? Because isn't it surprised you that things are getting kind of I think we're getting into the nasty phase for some people, and maybe if you're not in the real estate world, you don't see it. But some people are getting pretty tight out there. Yeah. But things have been held together.
Way more than you and I would have thought.
Yeah,
I think when you and I,
I thought two raises were going to be it. I'm like, oh, they can't raise rates more than twice. Like they raise rates twice, it's over.
Yeah, we're like,
it's over.
This will be a year tops.
Yeah, not like 29 raises for 2 years.
Yeah, no, it's quite interesting, and I will say this, and this does not get any mainstream media press. I don't hear really people talking about this at all, but in our business, we obviously, every time we speak to a client, generally speaking, if we need to do some work on their file, we have to run their credit. And so as you know, some of your clients even have been clients of mine for now over 15 years. And so we're privy to now knowing these.
Don't group our clients, whatever you're about to say next, okay?
It's actually a good thing, believe it or not. But the reality is that, we started noticing a pattern. So people were calling us in the last 2 years. We would get calls from, a family that we would normally look at and be like, they don't carry debt. They're not, they're very fiscally responsible. They live within their means, very, very just a normal, average application, a very good application. And now we're getting calls from them because naturally the renewal's coming up. So it's not like they're calling panicking, but they're calling to be like, hey, my renewal's coming up in like a year or 6 months or 2 years. And I just want to talk to you because rates are high. And, it's the first time in 15 years we're having to deal with this. So what do we do? And we're talking to them. And then we started noticing like a pattern where they're like, a lot of them were going, oh, by the way, you got to like with the renewal coming up, we got a bit of debt. And we were like, kind of wanting to see if we can like throw it in the mortgage like we've heard before with other people. And we're like, okay, cool, no problem. And we run the application. And then not only did we notice that, now they are carrying, without a doubt, comparative to years past, they are carrying a higher debt load on their high interest credit. There is no question. And we started noticing this pattern. We're noticing
high interest credit, so credit cards.
Credit cards, sorry.
Okay.
Yeah, they're holding balances now. They're holding high balances on high interest stuff. And previous years they would never do that. And that was alarming in itself. But then what we did notice is, and it's this actually, I believe it was like Lorenzo from the office actually brought it to my attention, and he said, look at their limit. And we look at the limit on the credit card. And we're like, wow, it's a TD credit card with a $35,000 limit. We're like, that's a big limit. And then we pulled the file from 5 years ago from when we worked on the client before. And the limit for the TD credit card in 2018 was like 10 grand. And then we went 5 years before that and we looked to see what their credit limit with TD was on that same card. And it was 7,500. So now you look at it and you go, 10 years ago, their limit was 7,500. 5 years ago, it was 10 grand, which is normal, right? 7,500 goes up to 10 grand. You've been paying your stuff. The bank gives you a little bit extra. Now in 2023, which would have been last year, we run their credit and their limit is 35 grand. They're hitting a balance of like 32 on it. So things are getting tight. And we're going, what the heck happened? So we actually and we start noticing this pattern a lot. Like this was like.
So the balance, the limit tripled.
Massive. And then finally got to the point where I'm just saying, Lorenzo, let's start talking to them and asking them like how this happened. So we would, you don't want to be like, how did, so you subtly like, we noticed your card was this. We're just curious. Like, we noticed your limit is now increased. Was there a difference in your income that we don't know about or something like that? No, this is the reply from the customer. No, but in 2020 and 2021, the banks were just sending us documents saying our limit's now increased by X amount of dollars and X amount of dollars and X amount of dollars. So, and I know anyone listening to this right now is probably saying like, oh yeah, that happened with me on this one credit card, or that happened with me on this one line of credit. I think that has a lot to do with Canadian resiliency, because if you're going to give a family, that normally lives within their means, access to about $50,000 or whatever that number is.
High interest, like the payments on that are ridiculous.
It's awful payments, and that's why they're coming to us in trouble. But the reality is that will get you, again, always remember, a family that's currently under their income living fine, but then now over the last like 3-4 years, what they've experienced, they've accumulated maybe 50 grand in debt, and it's high interest. But here's the thing, it's not that bad if you think about it, 12, 15 grand a year. But eventually, over time, it adds up, right? You know what I mean? Like 15 grand one year, okay, that's not that bad. Now it's 30 grand the next year. That wasn't good. Now it's 45 grand. Now they're calling and they're panicking, and rightly so, because they've never actually even had credit cards with that type of limit to be able to put themselves in that position. So I think there should be some blame, if you will. I mean, obviously, at the end of the day,
that feels like a credit line, not a credit card to me at 35 grand.
And it's too enticing, especially when we're going through what we're going through. I mean, everything costs more. If you're a parent and your kid wants X, you want to try to get them you want to get them in the latest school program or whatever it is, or extracurricular, or whatever that is. And all these things cost more money than they ever did. And, you're a parent. And here's the thing. The kicker is, and when we talk to them all, they always feel like, and they're not wrong for it, but they'll always say to us, well, we took on the debt, but we kind of knew our renewal was coming up and we'd be able to put in our mortgage because we know that our value of our home has gone up so much. So them knowing this, so it's kind of like, how would a family that normally does not use high interest credit now get into a position where they are using a lot of that high interest credit? What's going on? Well, because they now have this understanding within them that this house that they have was their savior. Now it's going to, when I come up for renewal, 50 grand, that would take me years to pay off. But now I can just like that in my renewal, I just get my mortgage broker to refinance it. Now where we're having problems though, is it's not that easy to refinance someone these days. At
these rates.
Yeah, and a lot of people don't know.
So, because before they would just take that credit or the debt, roll it in on the refinance, maybe bump their mortgage a little bit. It's a low rate, probably even lower than what they had before. So now they're like, who cares? I was able to buy like a jet ski and it's not a big deal.
Yep. And the qualifying rate was at the time, 4.79 or so. A lot of people could qualify at 4.79. The problem is I don't think a lot of people know this, or if they do, the math doesn't work great when you have the stress test. And the stress test is this thing that we know of that the government imposed that said, when you're doing a mortgage application, if the interest rate that you are going to get as a customer is, let's say, 4.5%, then we want the bank, and this is the government saying, this is OFSI saying, we want the bank to qualify you at 2% higher than that rate. So if you're going to get 4.5% on the rate, you have to qualify at 6.5%. Okay, fair, right? But what do you do when today's rate is like 6.2 and you have to qualify them at 8.2, and then you have an income of about $150,000, which is a solid income. But how is that going to qualify for a $650,000 mortgage at 8.2%? You have to understand the math doesn't math at that point. And that's where we're having problems. These people are coming, going, I got lots of equity in my home. I've taken on all these high interest debt. I'd like to clean this up. And we now have to be the messenger to be like, well, it's not going to get cleaned up right now because we don't qualify. Because where rates are at and the stress test and everything.
So what are you doing? Renewing them at
strategy? Well, yeah. To be honest, what you're doing is, and I've been saying this for the longest time, at least the last year and a bit. Renewals are it's not the rate you get. That is meaningless at this point. It's a strategy. The rate is super high right now. It just is comparative to the last 20 years.
So you have to get creative with what different banks are offering.
Well, you have to get more, in a sense, though, you have to get creative with your strategy. Because a lot of times, believe it or not, when that person doesn't qualify, there's not, the other option is do a super high interest loan, second mortgage, and is that really going to help them? So it now becomes a strategy where you're like, okay, look, I can't help you today with your problem. I mean, I can, but it won't be nice. But I can get you a much better solution potentially when the rates come down. So we need to put you in a position that you will be able to pounce if and when rates come down. And what is that? That's getting into a flexible mortgage. What is a flexible mortgage? Anything that we will be able to renegotiate, hopefully in a short period of time. So
like an open, shorter term?
Yeah, 1 year, 2 year, variable.
And you can pull that off because that's usually higher rates for the shorter term.
Well, this has been the hard sell because.
But it's like eat shit for this period of time. Cross our fingers. Rates are going to come down, and we'll get a much better solution.
Or go with like a 3-year rate at 5.11 or a 5-year rate at 5.69, and then the problem is, for those people, is that's not a great rate for those terms when you look statistically in the last 20 years. But also in let's say 2 years from now or 1.5 years from now, if rates are very low, they're going to be living with this insane regret. And now most people will say, well, who cares, Dave? They'll just pay the penalty and break their mortgage. Guys, I have to educate all of you at a rate of like 5 point something percent, and you have a bunch of time left on your term, and your mortgage amount is like $600K, your penalty to break your mortgage is going to be 5 digits. It's going to be like $30K, $40K. And now, is that going to make sense for you to break your mortgage to now take advantage of the lower rates? A lot of times it's set up so that it won't be the case. And so then someone just says, screw it, I don't want to pay that penalty, so I'm just stuck. And the worst thing, in my opinion, and being more in this financial world we live in today, is being stuck in something that you don't want to be in. That's and the option ends up being, I got to sell. Well, guess what? When you sell, you pay the penalty anyway. So it's like there's not a lot of wins here, right? But strategically, look, I think if that client was to go into a 1 year or go into a variable, and then within a year's time, the rates are lower, there's a very good chance now that we can qualify that client. But it's become, a lot of our conversations with clients are, you think you can make it another year? You know what I mean? And these aren't, I've never said that to
having those conversations. Yeah. I've never heard that. And all the time I've known you, I've never heard you say you had that conversation.
It's bad, man. It's, and again, I don't think the public knows about it.
The government must know that the consumer, like StatsCan's got to be looking at just their revenue data. Like with construction slowing down the way it has and resale real estate slowing down, think of how much revenue they get. They must just look at their own tax revenues and go, holy shit, like we're hurting here. Like they must be looking at this stuff. So they must have some insight. Anyway, what happens if we get you to break out the crystal ball and tell us like June, I think there's a meeting coming up, July. Yes. I think it's June, July, September.
You got it. Is I even got the dates. You got June 5th, you got July 24th, and you got September 4th. Yeah,
okay, so where are we?
How much I have to be on top of this.
So tell us. So, because in our office, there's a big argument about June because I've said, okay, Canada's like this weird test bed for America. The US election's coming. They don't know if they should cut rates yet or not. Why don't we just toy with this little country? Why don't we just give them the call and say, hey, you know what? Cut rates. Just like, we don't actually care about your data. Like, tell us some data if you want, but just go ahead and cut rates quarter point. We're just curious to see what happens. So this is how my brain works, which makes no sense because that would be coming from the Federal Reserve of the United States calling the Bank of Canada saying cut rates. But in my mind, it makes perfect sense because we're like this little test bed. And that comes from, I swear this was like January 2021, where over the holidays, prices of property went up like 30% in 6 weeks. And the Bank of Canada had a meeting. I swear it was January. Maybe it wasn't, but I swear they had
the 2022 one.
Was it the 2022 one? Okay. And they didn't raise. And that was, to me, like I already knew this was all a game, but that was the meeting when they didn't raise, when we all knew prices were through the roof, like 30% in 6 weeks, and they didn't raise. I'm like,
something's going on.
This is a fixed game.
Well, and remember, actually, it's funny. Well, there is some, there is, if you look deep, I mean, yes, they didn't raise in that January. The Fed wasn't doing anything. The U.S. Fed wasn't going to do anything at the time. And then there was a lot of backlash Bank of Canada took. And then what did they do in March? They reduced. And then what did the U.S. do in April? They reduced.
Is that when they? Oh, really? Okay, I forget the next. So
your story actually, like your idea, like that evidence I just laid out would not dispute what you're saying. Basically,
so that internally we're split here at Rockstar. Half of Rockstar thinks we're getting a cut in June, and the other half is like, nope. We're going longer.
Well, that's the I would say everyone I talk to is the same. And here's the crazy part: economists for major banks are also saying the same thing.
What's Benjamin Tal saying? I usually like his view.
Ben says 60% chance you get a quarter point in June. So next, I don't want to say next week, but whenever this airs, Benjamin Tal, the deputy chief economist at CIBC, believes 60% chance we get a 0.25% in June. I spoke personally to the B2B.
I thought you were going to say to the Bank of Canada, and I told them, I am Dave Butler, and you must cut rates.
Tiff, don't lie to us anymore, Tiff. Tell us the truth. Sebastian Lavoie, and I probably pronounced it terribly, but he is the chief economist at B2B Bank, which is a smaller bank, not a big six bank, but they're from Laurentian Bank.
Okay.
I spoke to him personally, and we were at a function. Spoke to him, asked him point blank, "What do you think?" And he says, "I think there's a good chance you get a 0.25 point cut in June." Now, I will say this personally myself, and I'm not an economist, so this is just me using 22 years of dealing with the Bank of Canada and everything else as to what I think was going to happen. But we put out a newsletter in December to all of our clients, and we wanted to kind of give them an idea of what we thought was coming down the pipe. And we were we have it in writing. We said we believe the first cut will be July or September with an outside chance of June. So we're right there. Look, you got economists that are saying they think it's going to happen. The factor that a lot of them use when we talk to them is that inflation, as we saw, when interest rates started coming down, what did inflation keep doing in those preceding months?
Kept going up.
That's right. So we all understand that even though inflation is coming down, when they lower the rates, it's not going to just immediately change things. These things take time. There's a lot of inflation.
I think we all know there's a lag. Yeah.
So the reality is that a lot of these economists are saying they think that the Bank of Canada might already be too late. And that, even with rate cuts coming in starting in June, that by December going into the new year, you could start to see inflation when you extrapolate out the extra housing costs, which will still be there even with a couple rate cuts, that our inflation number is actually getting to a dangerous level. And, we all hope that's not the case. And when I say a dangerously low level, which would then just go back to this merry-go-round of them having to aggressively cut rates, much like they aggressively had to increase rates. And obviously the Bank of Canada is finding a very tough balancing act here. But, look, that's what the economists are saying. Dave Butler, personally, me, I don't think you get the cut till July. Was there an outside chance you get it on June 5th? Absolutely.
Maybe July makes sense. Head fake everybody out in June, say some garbage language, then July, say, okay, finally, we capitulate here's a little bit.
Yeah.
We toss you a bone.
Yeah. I honestly don't think they want to, there's you and I know there's the spring summer market in real estate. It just didn't happen. It started.
I think a lot of people thought it was going to happen.
Yeah. I myself included.
A lot of realtors, real estate community, economists, media personalities, everybody thought it was going to happen.
Yeah. And it seemed like it was starting, and then I don't know what it was.
It was choppy. We did see multiple offers. There was a home here in Oakville that was at a starter home price, had 35 offers or whatever it had. But then other properties we saw just sit months, no offer. So just choppy market.
Yeah, it's been, I would definitely say this spring summer market was very muted, if you will. And I think that's...
How much do you think rates have to cut to get activity in the real estate market? This is another thing that we've been debating internally. How many cuts? Because some people think... there's buyers on the sidelines. Everyone's hovering around. I know they're out there. A quarter point with some language saying, that's it won't be the last cut is enough to make the market really get some juice behind it again. Other people are not until there's 3/4 of a point, because to qualify and get some mortgages for people, it's just a quarter point's really not going to be enough. What do you think to get some activity back to a semi-normal? I don't even know what normal is. 2014. I don't even know what normal is, but to whatever you qualify as normal, what do you think would have to happen with rates?
You need you're going to need 1.5% minimum.
Oh, really?
Yeah. So you're going to need the prime rate. The prime rate's going to have to go from 7.2 to 5.7, which means you're going to have people on variable rates at about 4.8 to 5%.
So the Bank of Canada's way too late then. These quarter points are useless then.
Yeah, based on what they're going to do, we won't be at that territory till the end of 2025, likely. They could end up, if inflation starts dipping to a point that they're uncomfortable with, then they'll aggressively reduce the rates. But from what I talked to with the economists, the plan that the Bank of Canada believes that they have is that they're going to roll out very stagnated and minimal decreases. So everything that I'm hearing is, you're going to get 2 to 3/4 point reductions this year. Probably 2, but maybe 3. So that's 0.5 to 0.75%. And then next year, you're probably going to get 4-ish, maybe 5/4% cuts. That's if it goes to their plan.
That feels way too slow.
Well, and that adds up to 1.5 to 2%. And so, that's from the way we're seeing people hurting on the streets. And I'm not just talking real estate now. Other buddies who have companies and running companies talking about the operating capital they're chewing through to just run the company, and some of the decisions they're making with personnel and inventory they're purchasing or not purchasing. I feel like that's way too slow of a pace, which I also recognize as a ridiculous conversation that we have to depend on some person at some institution in Ottawa to wave the magic finger and say, yes, population, here, I release the funds. Yep. Here you go. Yep. You can thank me later. Yeah, it's, we're in for an interesting time. At least I will say this. I think we're through what I would say is the worst of it in the sense of the uncertainty. I think there was quite a time there where a lot of us were just uncertain of how high are these rates going to go. I think the cool, I don't want to say cool, nothing's cool about what we're dealing with, but I think one of the good things was that at least in the last, 2 Bank of Canada meetings, you could kind of see the change in the language. I think even the last meeting, if I'm recalling correctly, Tiff Macklem basically said the next movement for rates is down. So kind of acknowledging that there would be no more increases unless something weird happened with inflation. So at least I think that is helping. To go back to your question as to like, what's it going to take for the real estate market? I do believe it's 1.5 to 2% reduction in total, but there's data behind that. And that is because when you look back at activity levels where they were in say 2018, 2019,
that's where rates were?
Yeah, that's where the qualifying rate was, right? Remember, the qualifying rate was introduced, it was like 17. It was like it went into like actually working in 18. But, you need a qualifying rate of about 5.5 to 6%. That's going to really get things going. And we all know what happens when the qualifying rate is 4.8. It's insane, right? So, and not to say that, because that's qualifying rate of 4.8 and then the interest rates were like 1 point something in 2021, right? I don't think we want to get there again. I think that was a very unbalanced market. But I think if you get a qualifying rate of about 5.5 to 6%, you're going to see quite a bit of activity. And to get that, currently today, someone who wants a variable rate today is going to have to qualify at like 8.2 all the way to 8.5. So a reduction of 1.5 to 2% of that is going to bring you down to what, 6.5-ish to 7%. We're still not necessarily there. But I think the other thing, though, that you got to measure, which is tough to measure, is sentiment, right? The first rate cut is going to provide people with a lot of just expressive air. I mean, they're going to, it's finally coming. There's promise. Mm-hmm. And I think that it's in itself will spawn some activity, whether or not it's activity that actually results in transactions. I don't know, because I have this odd feeling, and I was talking about this to my business partner, Dan, as we were driving in here, and I was saying, I got this weird feeling that when interest rates...
Dan's here and he didn't come in and say hi?
No, he was on the phone. Sorry. Yeah, he should. If he was here, he'd be doing this. He better be doing this with me. I think, and I totally lost actually where I was. Sorry about that.
Sorry, you're calling I lost it too. You were cutting rates. It'll come back to you in a second. But based on what you're saying, and when I'm just listening to you articulate this, it's like, holy shit, they are way too late. Because I know a lot of real estate people and business owners, but if we focus on real estate, that are holding on. And if they're going to cut rates that slowly, I think if they cut a little bit by the fall, some people are going to say, you know what, I have maybe a bunch of rental properties, sell a couple of these properties. So we get some supply on the market that's going to offset and mute any real estate run up.
That was it. So we have this feeling. You hit it. Thank you for reminding me, by the way. I can't believe I lost that there for a sec. But I have this odd feeling that you will get, and I'm calling it now, and if I'm wrong, I hope I'm wrong. That's the best part. I think you get a little mini crash in values. And people are going to be like, you're crazy. The rates are going to
No, I can see it. I can see it. Yeah.
Because we talked to a lot of people that are in, lots of properties. They got investors, they got properties. And there's just other people, just regular people that have actually decided they're not going to sell the home. Even though they want to sell it, they're not selling it till they hear interest rates are coming down. And I have talked to enough people where I have said, okay, there could be, and by the way, supply
I think you're onto something
is increasing steadily over the last little while. If you get just like a of extra supply, and remember, a quarter point, although sentimentally will be fantastic for us, and might cause people to sell
not enough to make an absorption in the market of that many properties.
Because what is that changing? The buyers are not buying because they don't qualify. Certainly it's because of affordability and everything, but a lot of them are not buying because they don't qualify. A quarter point, a half a point is not going to do much to qualification. But what we do know by talking to people is that it's going to cause some people to want to sell. So if you're going to add extra
need some liquidity,
pressure,
so eventually they just kind of have to. Like they've been holding. At some point, it's like, I can't hold. I need that liquidity for my own family and my own life. I have to sell something.
And they're waiting for that signal. And that signal is likely to be a drop in rates. And I just get this. And remember, it's also the timing. You and I both know there's a seasonality to real estate. So if this, starts to happen now as we exit the summer and go into the fall winter, which is usually not, you could find yourself, again, I don't want to be, I'm going to look really stupid if I say this is going to happen and it doesn't happen, but I think
we've all looked stupid for a couple of years now, so don't worry. I won't say you. I won't say you.
No. I have made some bad predictions myself too, to my staff in particular, telling them like, oh, this is going to be a year long. Don't worry. We'll get through it. And we're 2 years in. But I definitely think you might get a glut of supply to hit the market short term. When we talk short term, it's not like stocks where it's like a day. You're talking like this could be like a 3-4 month thing. You see a retreat in pricing because there just is too much supply, a couple new buyers coming in, but not as much. And ultimately, by the time you maybe hit the spring of next year, the rates have come down to a point where now there is this buyer cushion coming in and it starts to balance itself a little bit. But I could be wrong, and all of a sudden they drop rates and sentiment goes crazy.
No, but it's an interesting thing. And geopolitically around the world, things like, because we all are thinking rates are coming down. Then that's when I always get scared. Because I'm like, oh shit.
Contra.
We're all thinking rates are coming down. Like everybody.
I hate that.
Yeah, like everybody's thinking rates are coming. Because even if people don't think so, most people are going to say maybe at least 1/4 point this year. So then you can kind of get everybody saying the same thing.
Yep.
And so then I'm like, shit, geopolitically, if there's yet another war that outbreaks somewhere, and I don't know,
new pandemic,
some pandemic that starts, and it's like, holy shit, you could save the financial system by flooding people with more CERB checks and, we will save you, take this money, but keep rates really high. And the system could survive because as long as new money's entering, people can make their debt payments. Yes. You have a $35,000 credit card. Don't worry, we didn't know there was this geopolitical problem. We're going to send you like $8,000. We're going to, for your safety, we will send you $8,000 in the mail and then use that to pay us back like our credit card payments that you owe us.
Yes.
And then we get this inflation that kind of keeps everything going, but rates stay high. Rates staying high prevents money flowing into the real estate market. And then the real estate market could continue to get like depressed as you get a new wave of inflation that will hit like consumer goods, and you get like the GameStop action, you get all this kind of stuff. So part of me is like, oh shit, like what are we not expecting?
Well, and the crazy part is when you play that out, I'm listening and I'm following the whole thing, and I'm like, yeah, that's, and then you think about, okay, well, what happens then when it turns? You're like, well, if what you just said happens, and then they end up having to lower, the prices come down and they lower rates, all you've the thing is,
then you have to, if they lower rates, then it's with flooding the money, with new money flooded,
and look at the lower rates. And look how many people we have in the country now comparative to homes. Yeah. So it's just like you're really pushing an economic firestorm into something that is just just sitting there waiting for it, which is, and I still say this, we have just the most, and I know you guys beat your chest on, and I try to as much as I can, that there is a problem here in our country with respect to building homes. I mean, if other people are not worried about the fact that a lot of the tradespeople that are building these homes are going to be retiring in like 10 to 15 years. And we are not as a country promoting those types of trades. We aren't even bringing people from other countries that are into those trades for the most part. We are setting ourselves up, I believe, for a real disaster.
Dave, we've been trying to get eaves troughs fixed on a property we bought up at Collingwood. Yep. They just have no trades that they can get up there. They're like, it's not like the company itself's not responsive. It's like, we can't find the people who know how to do that type of work to get to the property to fix the problem. Like, we're on it. We just can't find the people.
Doesn't that scare you? Like,
it scares me because if we are growing the population, if this economic firestorm, like we just talked about, some version of that comes to fruition, and then, how you were talking about condos being built? Think about all the medium-sized builders that produce buildings right now. Would you develop a 50-person subdivision or 50-lot subdivision right now if you're a medium-sized builder with not knowing where rates are headed, with not knowing where the economy is headed? You don't know when you need to buy those 2x4s in 12 months from now. You don't know the cost that those are going to be. You're just sitting tight. You're probably just trying to survive to make your payments on the lots that you aren't building on anyway. Yeah. Nobody's putting up a pre-construction condo sales. There's some happening. I shouldn't say nobody, but not many. Yep. So you're not really selling anything. You're not developing anything. You're sitting on your hands. The workers that you have need to go find jobs. They eventually want to leave or just retire early, like you're saying. When you paint all of this together, it looks like the next 5 years to me looks like honestly, it's just an environment that I've never seen before.
Yeah.
And then you mix in technology advancements, artificial intelligence, geopolitics, like we were talking about. I'm like, what? I don't even understand. Like, I don't even know how to prepare anymore. Whereas before it was like, buy hard assets. Yeah, hey man, if you get some hard assets under your belt, you're going to be good. Mm-hmm. And now you look forward, and that could just be me getting older. Mm-hmm. Yeah, but you look forward and you're like, there's a lot of trends that seem to all be coming together right now. And it's, it's a little bit concerning.
Well, and it goes back to when we talked about, like, if you're young, you're a young person just entering now adulthood, and you're like, aside from just the dream of, or the non-dream of trying to afford a home, how the hell do you deal with all this other stuff that's going on? I mean, I also think it's pretty, it would be interesting to talk to someone that was around, when the other pandemic happened in, was it 1919 or 1920 or whatever it was. And like, how did they deal with the aftermath? And there must have been generations
after that. I think it was the Roaring
impacted.
20s and then the Great Depression, Dave.
Which wasn't great.
I shouldn't laugh.
And a lot of people compare.
I don't know why they called it the Great. It was actually the Brutal Depression.
Well, and a lot of people. I mean, remember, a lot of people have actually said, like, this isn't actually. And I'm not tinfoil hat guy, but there are some smart people that I listen to that have said, look, this could just be the first wave of this. This is, and they take the charts and they overlay the crash from the,
which is fun to
20s.
do. Let's face it, that's fun to look at these patterns.
Definitely,
yeah.
But it also, and the reason why I want to talk to those people is try to find out, like, what was the mindset when they were coming out of it? Because, are we entering that same thing where, governments are going to reduce rates, maybe geopolitically they have to do it even more rapid, and it causes this second wave of inflation potentially, and that's the one that creates this huge depression? Or are we in the Great Depression right now?
Yeah, we
didn't even know.
I think we might be in it because I think something changed structurally in 2008 when central banks discovered they could do quantitative easing. Because if you look at the base money charts, it's like it never moved. Then in 2008, they just started going up and up and up. And I think they've discovered, like, oh my God, you know what? It actually doesn't matter if we hit another pandemic or some geopolitical problem for the economy.
We've got our tool.
We have our tool. We will just debase the shit out of the money.
Yep.
We will helicopter it out. We'll send Dave his safety first CERB grocery check. Yep. And if we just do that, then if the people who have nothing, they don't get affected because they now have a check and they can go buy food, even though the food what they can buy gets more expensive. They can buy something. People with assets, really, when you debase the currency, the asset price, the nominal dollar price of it kind of goes, and so you're going to be okay. It's like the people who have just some like cash savings, they kind of lose in the middle. It's like you destroy the middle class in that process, but the rich kind of stay rich. The poor had, they were hand to mouth anyway.
Well, actually, I have a question for you. Actually, this is a very interesting question. Are you, and this is respect to the middle class and the destruction of it as I see it for the last little while, but do you know people that are actually, that you've spoken to, that are deciding, hey, this isn't for me anymore. I'm going to take my business. I'm going to go to a different country, or I'm shutting my business down. I'm going to do something else. Like, have you had people in your life telling you that in the last little while that you normally would never hear of that before?
Yeah.
Okay. Cause like
way more than not way more. Before it was zero.
Yes.
So now I have multiple people. Not only do I have multiple people, just 24 hours ago or 48 hours ago, a friend of mine sent me a message saying his buddy that runs a cattle farm north of Toronto, shutting it down, doesn't want to be here anymore, moving. I think he's going to Texas, and he's out. We have clients who've moved to Mexico, we have lawyers who tell us, 5% of their business now, which they never anticipated, is just helping the Canadian clients they have leave Canada. Yep. I've just never, ever had that.
Sorry to interrupt you. I was going to say, I own a property in Aruba with, my wife and I own a property in Aruba with another couple, and James is his name, and he grew up here in Mississauga, opened up restaurants. He's on Lakeshore. This is a guy that had multiple restaurants right on Lakeshore, Mississauga, like extremely high traffic area. Everything is, and he got put through the pandemic. We all know what happened to people that had restaurants and bars through the pandemic. And coming out of the pandemic, obviously, the hope was he would get his, okay, great. Now let's get back to business. Like 6 months ago, he says, I got news for you. I'm and good for me, because he said, I'm moving to Aruba. And I'm like, oh, that's great because you can look after our property more.
Property management.
I was like, fantastic.
Property manager, perfect.
But it made me so sad because this is a guy, like he's from Greek descent, hardworking guy, built these restaurants up from scratch. Like this is a guy.
What was the straw for him?
Government, and it was just the way the country was
Capital
going.
gains,
And to be
the
fair,
announcement of the capital gains possible change, maybe.
He had a big bone to pick with the way that the government handled the pandemic in terms of how it affected his business. I mean, I think for any of us that know people that own restaurants, it was, you were kind of thrown out there on your own, and it was like, if you survive, great. And afterwards, I felt like maybe the government didn't necessarily try to put them in a better position, or at least try to, like they did with other people in the country. And I think he was already getting sick of that. And I think just as our political situation has gotten worse, it just, and by the way, he called me when Trudeau came out with his new budget and the new capital gains tax. And he just called me and said, I made the right decision, didn't I? And I was like, yeah, based on what you're doing, because he's a restaurant guy. He can go and open a restaurant or a bar in Aruba and it'll be successful. And he's now to a point where he's decided that is better for him and his family to go to an island in the Caribbean and do what he does. And I think what's very, very, very sensitive about that, and what's really like where we need to really look at the heart of that is risk capital that is leaving our country. And I think a lot of people don't realize what risk capital does. People should really look at what happens when risk capital leaves a country. You lose jobs. You lose jobs that people, if you're not promoting people that are willing to put in capital and risk it and build businesses, then you are now taking that out so that the only thing left is just these conglomerates, these huge businesses, because that's the only people that are left. And the problem is then you just end up with a
socialism,
effectively, right? And it's I think that's scary. Like, I actually think, like, when I look at Canada, when you and I grew up in this country, and I'm just like, man, my parents, like, if they had a dream, they could try to achieve it. And if your family came from Europe and they were really good at making food, and you're like, I want to build a restaurant here in Canada, that dream is like kind of gone now. Like, it's now there's no, because the amount of money you have to put up and the return on it, and then the uncertainty with what your government is going to do, imagine that, like, you invest in Canada and then you find out the next, like, imagine you thought it was a smart move to start investing in Canada in 2023, you know what I mean? And then you literally wake up in 2024 and the guy's like, well, we're going to tax you more. And it's like, is that really the answer here? Like,
and when you say risk capital, like, capitalism is the formation of capital. You take a risk with your capital. If you risk properly, you get rewarded.
Yes,
if you risked incorrectly or poorly, you lose.
As you should.
So we just don't have that happen anymore. So you basically lose capitalism. And then we're in an environment where a lot of people who, this guy, I don't want to put thoughts in his mind or what could possibly be going through his mind. But if you're saving, if you save up some money to take that risk, then you think, okay, well, then I'm going to be taxed on any income that I earn. And then when I take the money that's left, when I go to spend it, I'm going to be taxed again. And then the business that then receives the money. So if I earn $100, I'm taxed on it. And then let's say I have like $70 left, and I take that $70 and then I go spend it somewhere. I'm then taxed on it. So what do I have? Like let's say $60 left. Then the business that accepts that $60, they're then taxed on that $60. You run that through a few times. It's like the government then eventually takes like 100%, or we're just doing fractions at a certain point. The government's just taking it all. And then on top of that, while that process is happening and the government's just taking the money through tax, you're debasing the currency through quantitative easing of some sort, where you're saying the dollars that are left, we're going to make them worth less and less and less. And you just look around, you're like, well, why am I even working? Why even bother?
What's the point?
And then people will say to the younger generation, well, maybe they're lazy. Well, maybe it's not they're fucking lazy. Maybe it's like, what's the fucking point?
Maybe they're disenchanted. And that if you especially with young people, if you take hope away from young people, and what the hell do they got left? You know what I mean? Because generally when you're young, like, it's what you see, and knowing that if you put in the work, you can get there. And obviously in life, you got to have goals, right? And I mean, when you start moving the goalposts on people, that's eventually, some people will be like, oh, you moved the goalposts. Okay, I got to get there now.
I think we can all handle that for a little while.
Yeah. But there's also some people that are like, fuck this. You keep moving the goalposts. I'm not playing your game anymore, dude. I'm out of here. And that's what's happening, sadly, I think. But I think the erosion of of risk capital, and the risk capital leaving our country is going to present us with quite a problem. And I mean, we even talked about in, little things like 2028, we looked at you and I were looking at a chart. In 2028, the actual estimated amount of condo unit completions in 2028 in the GTA, which houses how many million people, is 5,000 units. Now, some people might say, well, that sounds like a lot. It's not a lot. 5,000 units is 5,000.
Because the average you were just showing us
was like 20,000, something like that. We're going to be like 75% under the average. And why is that? Well, that's because right now no one's lining up to build. And if you're going to go build a condo in Toronto today, it's not going to be ready till probably 2029, 2030. So they've gone, obviously a statistics company went and found out that based on the current projects that are in the GTA for condominiums, there will only be, come 2028, 5,000 completed units. That's set. Look, there was probably 5,000 people flown in yesterday to Pearson Terminal 3 that are brand new to our country that are going to need somewhere to live. And that's happening on a daily basis.
So we're going to go from like, oh my gosh, there's a soft condo market. Look at all these completions coming and, there's assignment problems and all this stuff, to like, holy shit, there's no condos available. And that's kind of like the madness when you try to centrally plan this kind of nonsense. Something I wanted to ask you about was, are you seeing a lot of banks or a lot of pushback by Canadians who have banks saying, hey, you pony up 10,000, 15,000, you had a variable rate mortgage, you weren't paying enough into the mortgage because we kind of flatlined it, but you got to give us like 15,000, and even though your renewal's a year away, like you got to, and are you seeing Canadians push back on that? Like say, forget it, I don't want to?
Well, we've found so many new news in this world, in the mortgage world, and for how long trigger rate was something that has been in mortgage lexicon for as long as I've been in mortgages, but you never hit it. So it was like, I've heard of trigger rate and I've been doing this for 20 years.
For those people who don't know what it is, can you describe?
Well, it's basically, it specifically is with specific banks where their variable rate product is set up that the payment doesn't change as the rate changes. And I call it a static payment. So CIBC, BMO, RBC, and TD. If you have a variable rate or an adjustable rate mortgage, it calls it different. There is an actual meaning to both of them, but they get confused. But anyone with that type of a product, with those banks, you actually haven't felt the pain per month of your mortgage payment changing. But inside your mortgage, there's this thing called the trigger rate, where once your interest rate hits a certain level, you're now paying 100% of interest and no principal on your mortgage, because your payment stayed the same, but the interest kept changing. So now effectively it starts over time wiping out the principal you're paying, to the point where eventually you'll get a notice from the bank saying you've now hit your trigger rate. Now here's the kicker though, what we found out. Some banks were aggressively contacting clients when they hit their trigger rate saying, we're going to increase your payment, or you got to come in and redo your mortgage or whatever, so that you didn't have an amortization that kept growing. But there are some other banks that didn't do that. And I can tell you with 100% certainty with my own eyes, I have clients right now on variable rates with TD Bank that they've passed their trigger rate. TD just sends these soft emails like, hey, you've hit your trigger rate, contact us. But they're not
it's not like
aggressively forcing anything. And so some of these people have amortizations of like 120 years now. They literally started at 30, and because effectively the rates went up so high that they were now no longer paying out of that payment, because it's static, no more of it's going to principal. And as the rates kept going up, now it's adding. So I have people every month that their mortgage balance is increasing.
Even though they're making a payment.
Even though they're making a payment, because their payment is only covering a portion of the interest. The rest is being tacked onto their mortgage. That to me, like, I've never seen that in my life.
But do you think the banks are being soft? Because didn't the government come out at some point and say, hey, Canadians, it's going to be okay. Like, the banks can't push you into anything. Wasn't there something? No, am I remembering incorrectly?
I mean, always, I think in banking, and especially with mortgages, the government's always going to be on the side of making sure people are staying in their homes and whatnot. I also, though, look at it from a business. I don't know if the bank, like, what bank is going to want that story on the front page news, you know what I mean?
Yeah.
I think ultimately, and to be fair, I think the banks have probably done their risk analysis. It's not like this is new. There's pretty smart people at these banks, and they know what's going on, and they look at their portfolios and they look at their, overall loan to values and everything. And I think as a whole, they feel fine. I'm sure they're concerned with certain instances. But I mean, overall, we are in a banking system that is set up to continually be relatively healthy when things are still pretty bad. And that is a benefit we have. We're not like the States where there's private banks, there's 4 different banks in one corner and 5 different banks on the other corner. And, there's probably 18,000 banks in one state out there. It's different. We do have more of a centralized system, which I think helps us. But also, I mean, we're getting to a point where, which one is better? It used to be like, oh, ours is better. And then, but is it? Because out in the US, a lot of people don't realize this. They're not, people have said to me, like, why do you think the US, their GDP is still doing well? They're really doing they're really doing well. And I said, well, I don't know. I mean, I'm not an economist, but I'm a math guy. And I think, look, if you understand how U.S. mortgages work, these people are signing 30-year deals. They don't sign, like in Canada, we sign 5-year fixed rates, 5-year variable, 3-year fixed, 2-year fixed. In the U.S., that is not traditional. And out in the U.S., they're traditional is to sign a 30-year. So guess what? The U.S. doesn't have to worry about renewals coming up for the most part. Very little. Not like us. Like we can say in Canada that within a 5-year span, X amount, like 80,
maybe this
90%.
Is the best reason we are going to get rate cuts, that the banks are just going to say, hey, listen, Bank of Canada, you know what, jam some of these through because so many renewals are coming through in the next couple of years. We need these rates to be lower for people on renewal.
Yeah. Well, I think Canadians currently are having your income, your disposable income is being chewed up in higher interest. And for those that are on variable rates and their payments went up, they experienced this high level and that purchasing power has now disappeared. In the States, because that's not happening. So their purchasing power has not necessarily been affected other than just natural inflation. So the idea is that in Canada, when you're comparing apples to apples, it's like we have people currently that are losing disposable income immediately when their mortgage renewal is coming up. Whereas in the States, that's not happening. And so maybe that's why some of the businesses and are still thriving out there and why the US is doing a lot better than Canada in a GDP situation, because they don't have a lot of those same issues, right?
It sounds okay. Last thing I want, what is the Butler 100?
Sorry, I laughed really hard in the mic there.
Yeah, what is it?
All right, we're doing this. I'm doing this thing. So, like, basically, as you know, I've been in the mortgage business for quite some time. I actually like, and this is crazy, but like, I like doing owner-occupied mortgages, and this is just a selfish thing on my part. Like, listen, don't get me wrong. All of my investor clients, I love you, but sometimes it's, from my standpoint, it's a lot harder to work on a file where there's 10 rental properties and, it's a lot of paperwork. It's a lot of strategy. You got to really you got to put hours into some of these files. A regular owner occupied, you get a call from someone, they're selling their house, they're buying another one.
It looks simple to
be honest with you.
Right?
It's a fairly easy application to do, especially if you've been doing this for 22 years and been working with files that are very, very thick. I like them. So I wanted to kind of, I did a bit of an appraisal of my time, if you will, and based on my current roles in the companies that I work in. I felt like I did have probably 3-4 hours a day that I could put into doing something that I really want to do. And I remember I was talking to Nick about this actually before, and I was like, man, imagine and I know maybe you don't want to do it, but I'm like, it's kind of like, if you really liked showing a house or you really liked showing clients houses when you guys first started the business, and you really liked it and you had a chance where, your companies are running fine and you're able to do that again, would you do it? And maybe you might say no, but in my case, I have a 2-year-old. So retirement kind of stopped. My retirement dream, which I was living it slightly, kind of stopped when, you have a little kid and your perspective changes. And I thought, well, I don't really want my kid to grow up seeing dad in semi-retirement mode and not, I want him to grow up knowing his dad worked hard and teach him a work ethic that I think is important. And so I thought, well, I don't want to just sit on a couch and, especially when he's eventually in daycare, it's like, I got to do something. So I felt like, I should put some time into something, and I tried to think of something cool and what could be beneficial for your average Canadian and how would it also benefit me? And I thought, well, look, why don't I do this? I like working on those files. I like when a client, it's a fairly simple file and ultimately also know that on those mortgages, I can fight to get the lowest rate possible. With rental mortgages, a lot of real estate investors know this already, but some that if you don't, you don't get the same rates for your rental property as you do on an owner occupied. They're much, not much higher, but they're higher. And there's less negotiation with the banks because they kind of know, hey, you're an investor, you got to take what we got. Whereas when it's owner occupied, the banks just clamor for that. They all fight hard. So there is much more of that negotiation and that fighting. Like, I can actually really be a broker now. You know what I mean? I could really like go at the banks. I can be like use leverage and whatnot. And so I thought, what would be a cool thing to do? It's like, okay, I probably can work with about 100 clients a year personally. Like, I'm going back. I'm literally like 22 years later, I'm going full circle. I'm going to go back. You'll talk to me. I'm going to work with just 100 people. And the goal is basically what I'm going to do is the banks, in order, how they compensate mortgage brokers is by paying a finder's fee, right? So you do a mortgage for a customer and the bank will compensate you with a finder's fee. Well, I can use that finder's fee to actually lower the client's rate. You know what I mean? And I'm in a precarious situation where I am very lucky. I'm very blessed. I've been in this business for a long time. It's not about money for me. It's just about like, living life, having fun, doing cool things, helping people. And so I thought, look, what would be a cool thing? I'm going to work with 100 people. I'm going to use my finder's fee to buy down the rate. So I'm not getting anything. They'll end up with the lowest rate possible. Okay. That's the goal here. I'd like to hopefully save every one of those 100 $10,000 in the course of their 5-year term. If you take 100 people times 10,000, that's $1 million. I could take $1 million out of the bank's pocket. And now some people will say, well, what do you get out of it? Well, I just started, as I said to you, when I started the program, I just opened up a brand new brokerage. I've left my other brokerage. I've started a brand new brokerage. Banks love volume. A lot of people don't know this, but the more volume you do, if your brokerage is doing a lot more volume than the next brokerage, your brokerage is probably going to get lower rates to start. They're probably going to get more favorable approvals. So if you're starting up a brokerage and you have an avenue like I do to be able to work with clients right away and provide these banks with a lot of volume, especially for a new brokerage, what it does is it actually gets our brokerage back on the map with these lenders, getting lower rates. And it just benefits everybody because our investors, the people that work with Better Mortgage Select, they will now benefit because the brokerage as a whole is doing more volume. And I just thought that would be a cool way. It certainly helps me. And people will be probably like, what are you getting out of it? Look, it's not about money for me, but it's about getting better rates as a brokerage, getting better favorable approvals, getting better underwriters at banks. A lot of people don't also know this, that at every bank, there's different, skill levels of underwriters. And when you're newer, they're going to put you with the lesser skilled one. And when you're experienced and you do a lot of volume, the bank will put you as valuable and they'll assign a really good underwriter to your file. That all plays into it. So it was kind of like a win-win. We just thought about let's take some money out of the bank's pocket. Let's keep it in the client's pocket. And it helps us because our brokerage now does more volume. And that's something that's very important in this game. And, a lot of even mortgage agents and mortgage brokers don't necessarily know that, there's behind the scenes, rate discounts that can happen when you hit certain volume levels. Because sadly, if you're just a mortgage agent, and this isn't a bad thing, but even $50 million in volume, that's a lot. To the banks, that's nothing. But if you're a brokerage, you might be doing $1 billion in mortgage volume. And now you can actually move the needle a bit on your side. It will benefit your customers.
You matter to them.
Yeah, so it's Dave Butler 100. A very cheesy name, nothing really special about it. How do people reach
out to you? Just through the website for everything? Is it the same?
Yeah, so we're actually going to be launching. It's like, how it goes with websites, man. Oh my God. But development and changing stuff. And I'm a perfectionist with that stuff. So I want to be perfect. So we're back and forth with our web team. We're going to launch it officially probably in a week or two. As soon as the website, I'm ready to go. Technically, I've actually already been working with a couple of our other clients and their sons and daughters.
Are we sharing a URL now?
Yeah, it's davebutler.ca. They can go to the website now. It'll just be a landing page, but it will be.
Can they reach out to you through the website now or no?
Yeah, I don't think you could. You could, if you want, you can just reach me. My email is pretty easy, dave@davebutler.ca.
Oh, perfect.
And the website's obviously www.davebutler.ca. I am on Instagram, Dave Butler MTG, which is just the acronym for mortgage. I'm going to get myself out there a lot. It's time. I'm going to, me, we were talking earlier, I'm like behind the scenes. I was always the underwriter. I wanted Dan and them to be, the sales, and I really enjoyed the underwriting, but, I just, times change and I'm pumped. I'm pumped to actually work with clients.
Dave 2.0. Appreciate it, man. Thanks for sharing all this. I appreciate it, Dave. Thanks for coming. I always enjoy talking to you, getting your perspective, man. And I can't wait to see the next few years with you, what you're going to do. By the way, dude, you are dressing well. You are looking, hey, you are looking good. You are looking good.
She does not let me leave the house in Pittsburgh Steeler gear anymore. So.
Thank you, man.
Thank you.
Appreciate it. Hey, thanks for tuning in. You can find every new episode of the Your Life, Your Term show on all the major streaming platforms. So Spotify, iTunes, Google Play. And if you'd like to get free copies of some of the books that we've put together, like these right here, or some of the reports that we've put together, like these right here, you can find all of those at www.rockstarinnercircle.com. That's www.rockstarinnercircle.com. That's it for now. Until next time, your life, your terms.